become the reserve currency. You now have the ability to print money to cover up problems. That begins to change the way that people perceive money, even at the governmental level. So now all of a sudden, people start trading what works in a free market sense of working, that you spend $1, you get 2 in return. It exchanges that for, I think morally, we ought to do this thing. We do it, it's not working, meaning that we're losing money. So you get the 2008 crisis, but they're like, what crisis? We're just gonna paper over it. We're gonna print money. It was bad, but it wasn't fall off a cliff bad. And so they print over that and they go, oh, look, see, that wasn't that bad. And we were doing something good. Yeah. We're trying to be moral actors. Because to be honest, like, this was the big awakening that I went through. I'm like, this sounds awesome. I love that you're ending redlining. You're getting people onto the housing ladder that previously weren't. Like, it all sounds amazing. But then Thomas Sowell comes along and he gives me this idea that then you start watching play out, which is the last 30 years have been marked by exchanging what worked for what sounds good. Now, when you tie that to debt, because again, my whole thesis is that the collapse begins with debt. Because if you don't have debt, you can get away with some of this. But the problem is you end up getting into the moment that we're in now, which is why you talk about all these problems happening at the same time. The reason I think this becomes that you're potentially about to walk off a cliff is because you have all this debt. The government has a full GDP in debt. US households have full GDP in debt. Corporations have full GDP in debt. And so now all of a sudden, the only way out of that debt is to either lower your interest rates, which if you do that, then you're gonna have inflation, to print money to cover some of your debts, which again, inflation. And so if you have to print and you can't lower rates anymore, now you're in trouble. So they start raising rates. The problem is everybody's got all this massive, massive debt. And this is where editors put back up the debt ceiling picture where we see this huge spike in the last year where it is just massive. The amount of extra debt that we have right now is not a little, it is unbelievable. It's like 400% more than normal. It's just absolutely astronomical. So you have this massive amount of debt. You can no longer lower interest rates. In fact, you have to start raising interest rates. The Fed gets everybody, again, this is me quoting you, the Fed gets everybody to buy into the bonds, treasuries, like, hey, rates are gonna be low for the foreseeable future, all's good. And then whatever, 6 months later, they take them to the moon, the fastest rate hike in history, or certainly recent memory. And so now people are like, whoa, all these bonds that I just bought, they're now toxic. I can't get them off. SVB fails, everybody's blaming them as if they did something crazy. They put all their money in like the supposed safe asset. And so now you're in this game of like, the only solution left is to print, because you can't lower interest rates, because if you can't lower interest rates because of inflation, you can't raise interest rates because you will break the economy and more people aren't going to be able to pay their debts, including the government itself. And so now you're in a conundrum where all of your tools are gone except printing money. And so the question that I'll ask you point blank is, we've printed a lot of money and nothing bad has happened. So why now? Why is it a problem now?
In short, like, the system is starting to creak and you're starting to see what I'd call consumer failures, like in the sense of in 2008, when you went to your ATM or something, that just continued to work. The failures then were like enterprise failures, in the sense that there were guys who were sweating in skyscrapers with pieces of paper back and forth that weren't worth what they thought they were. Now you're having banks blow up on Main Street. You are having it is becoming much harder to cover things up, because we just talked about the fact that all these banks blew up, the fact that there was this near miss in the debt ceiling, we've got people talking about debt again, the fact that there's 2.2 trillion in unrealized losses according to the Stanford study, and I'll come back to what those are. But we have commercial real estate crisis due to remote work, due to all the crime in blue cities and so on. Commercial real estate prices could crash 40% from their peak in a worse disaster than the financial crisis, Morgan Stanley warns, okay? That alone is pretty bad, right? 2022 was the worst year for bonds, evidently in recorded history. So it's a bond crisis, not just a bank crisis, and everybody buys bonds, as we'll come back to. That's actually at the core of a lot of this. Bonds are seen as a safe haven, but they're actually central to this crisis. It's not like a It's a crisis that's caused by governments, just like 2008, but even more directly. Insurance, remember AIG when they went down in 2008, like the guys who are supposed to backstop everybody, So today, insurers also bought a lot of bonds, and double-digit percentage of their portfolio, which are supposed to be safe, are held in now essentially these unsafe assets that are being devalued in a big way.
Isn't it like 70% of their portfolio?
Yeah, exactly. There's a graph here. Life insurers have like 70%, and you can go to other kinds of insurers. And the thing is, life insurers, you might say, oh, well, that's different than real estate insurers. There's actually been a collapse in life expectancy in the US, like this overnight huge collapse. So life insurers are paying out way more than they expected. And so lots of insurers are just getting, they have to pay when they didn't think they were going to have to pay. Okay, there's insurance crisis, there's a fiscal crisis, 1.4 trillion in unfunded pensions. There's auto loans, spiking defaults in that $1 trillion plus sector. There's student loans, payments may resume on 1.8 trillion in debt after this multi-year holiday due to COVID. And it's almost like the worst, right? If you just kept it or you'd forgiven it, right? Both those, would have been better than suspending it for 3 years and then resuming it, because now what's happened is people didn't sock away the cash for a rainy day, right? They didn't use it to pay down the debt. They just expanded their spending, and now suddenly, and many of them probably gambled that the student loans would go away forever, right? And because it got suspended, now they're coming back. They're like, oh no, and now they've got it on top of their rent payment or something like that. So that's going to be another.
Well, let's use this as an example. So why then don't we just forgive that debt?
Well, first, that's a huge tug of war between two groups. If one man's assets and another man's liability, you are marking down $1 trillion on someone else's books, and they will fight tooth and nail to stop that from happening, right? So it's a zero-sum game. It's like, if you have the debt, you want it to be marked down. If you're the lender, you don't, because that's your revenue stream, right? That's how, maybe if you're a college, that's how you pay your administrators or whatever, right?
But then why doesn't the U.S. government just pay that debt?
Well, it could. And if it does do that, then it's just printed a giant amount of money. And then people will say, why don't you print my mortgage as well, not just my student loan debt? Why don't you print my car loan away, right? And once you've kind of broken the seal on that, that's like the people's QE, the people's quantitative easing, where the money is printed not just to bail out banks, but to bail out everybody. And you know what? Like, at first, some people will love that. But that much introduction of money into the system starts actually devaluing the currency itself. So we talk about the student loans. There's credit card debt, almost $1 trillion of credit card debt, record high. Okay, there is, and there's yet more, right? Globally, there's the Ukraine crisis. That's like at least 100 billion in. It's like 100 billion in direct costs for just the arms, but that understates it. It's easily $1 trillion indirect. Europe alone paid like 800 billion in energy costs. So it's like a multi-trillion dollar war. People say wars cost blood and treasure. Just think about it. Like you've seen obviously these bombs blowing up things in Ukraine or what have you. Think about how expensive a building is, right? It's like somebody's entire life to pay for like a house, 30-year mortgage or whatever. So now you have a bomb that blows up like 1,000-person apartment building. That's like 1,000 economic lives wrecked, right? Even if the people didn't get blown up, it's like 1,000 healthy working, people's 10 years of their life or whatever is consumed if at current very high housing prices. So when whole cities are leveled and stuff like that, that's a lot of damage, right? And that's just within the country. Obviously outside, the energy crisis is tremendous, and of course the humanitarian crisis is tremendous. You also have, it's the Ukraine crisis, you have the energy crisis in Europe, and some people are like, oh, well, prices are down, this energy crisis is over. And it's like, well, what was the cost of that, right? You had demand destruction. You had businesses that shut down because they couldn't afford the energy costs, and then they stopped consuming energy, and maybe, that's why energy prices are down, because they're not consuming. The level of demand destruction that probably happened in Q4 of last year, you need to see stats on it.